Okay, the big thing or the big question that is, or the big trend that seems to be emerging is around MHCVs or medium heavy commercial vehicles. And the question that we ask is the cycle turning? And there are various data points to mark this. Now let's get those data points up and running out here. Some of these are of course the numbers that came out. So the numbers for both Tata Motors and Ashok Leyland for the month of November were at least 30% growth. Ashok Leyland was 30, Tata was slightly more, but at least 30% growth. Now 30% is a strong number. Now remember, this is of course what they reported, but if you just look at what's happening on the retail side as well, those numbers are up 24%. And from the looks of it, the data around the month of December on the production running up all the way to March is looking solid as well. So in some sense, it is not just a flash in the pan move, it is looking good. Keep in mind, the LCV growth has been strong too, so that's the other part, that it's not just the medium heavy side of the commercial vehicle segment which is doing well, LCVs too are doing okay. But like I said, let's move on to the next plate. Like I said, what is important is the trend that is building up. Now remember, industry remains below the FY29 all-time highs. So if you thought that this trend that is building up is looking too fast, too strong, we're still below the FY19 levels. And therefore, people would presume that there is room to go. The economy is much larger. If the trend starts to build up, can we eclipse this FY19 highs? Yes, we can. So that is the other point to note. And like I said, December production schedules look robust, and most people that you speak to will tell you that when this uptrend starts, it lasts for a couple of years. So don't look at it just from a 1 month, 2 month, 3 month perspective. I think the momentum will last well into March 26 for sure, but maybe beyond that as well. So how to play it? Of course, the OEMs, you already know where they are, but there are auto ancillaries that you can look at, which a lot of people say. So auto ancillaries with a high MHCV and a tractor exposure, Sundaram Fasteners, Happy Forgings, and some of the others might have too. So, and this is just a sample set, by the way. You can also look at financiers, and there are some financiers with a very high MHCV financing exposure. Shriram Finance 48%, Indostar 42%, Chola 35%, M&M Financial about 32%. If you believe that the MHCV cycle is here to last, then these are some of the players that you could study, research, do a valuation check, and then take a call if you want to invest or no. But yes, does it seem like the MHCV cycle has turned the corner and is on an uptrend? The answer is an unequivocal yes. Now the key is, guys, I don't know how you guys think about it, but I would love to know what Mayuresh thinks about it first. Unless Hiral or Alex, you have a view on this. Okay, Mayuresh, can I first come to you? Do you believe the MHCV cycle has turned? And do you believe there is worth investments into the OEM or the auto ang or the financier?
Yes, data points are suggesting, Neeraj, that the cycle is turning for the better, and you're absolutely right from the data points that you have presented. Obviously, a base case scenario does happen for the case of OEMs, whether it's Mahindra & Mahindra, Ashok Leyland, or Tata Motors CV. But alternatively, I think what we are also looking at outside the obvious names are tire stocks. Tire stocks are something that will benefit significantly. So I think if you look at the entire ecosystem, whether you're talking about JK Tyre, Apollo Tyre, SEAT, but more or less JK Tyre and Apollo Tyres, I think a large part of their exposure probably still happens to be the CV segment. And within the CV segment also, I think a large part of that does come through as a good mix between replacement and OEMs. So as the cycle is turning, where the replacement demand comes back very, very strongly along with the OEM demand, volume uptick is something that is probably guaranteed for the sector as a whole. With input costs staying a little bit benign, EBITDA margins have seen expansion in Q2, might expand even further as we head into the second quarter. And operating leverage will get play out because debt levels have remained consistent, and with improving cash flows, both profitability and return ratios might improve. So tire as a space might do.